Hey, welcome back to Compounding Quietly. Most investors spend months picking the right ETF, but almost no one stops to ask if their own thinking is ready. That gap is more expensive than any expense ratio. Let's get into it. There's an assumption most investors carry. The assumption is that better information leads to better decisions. Research enough. Compare the options carefully. Understand the structure of what you're buying. Then you'll act correctly when it actually counts. That assumption sounds reasonable, but it has a flaw most people only discover under pressure. Think about what actually happens when the market drops significantly. You've done the work. You know what you own and why you own it. You've told yourself you're in this for the long term. And then the market falls 20% over the course of a month. Suddenly, you're not thinking about dividend growth over the next decade. You're watching the number in your account fall with each passing day. You're checking prices when you wake up and before you sleep. You're reading discussions where investors are talking about getting out entirely. And the question begins to take shape. Should I be doing what they're doing? That shift from a clear plan to an emotional reaction doesn't happen because you didn't research enough. It happens because you hadn't examined in advance how you would actually behave when everything you believed was being tested by the market. The research phase has an endpoint. At some point, you make a decision and you hold. And what happens in the holding phase is determined almost entirely by something the research never covered. How you respond when the numbers move against you. Most investors encounter this for the first time, after the damage is already done. The position drops. They respond emotionally. They either exit too early or freeze when they should be adding. The cost becomes real, but the lesson arrives too late. There's a book that speaks directly to this. It doesn't explain which stocks to buy. It doesn't outline a portfolio construction strategy. It examines the internal dynamics behind every financial decision a person makes and explains why even well-informed investors repeat the same costly patterns. That book is Morgan Housel's The Psychology of Money. And in my view, it's the one thing worth reading before putting a single dollar into the market. Not because it changes what you invest in, because it changes how you think about why you're investing and what you'll do when the plan is tested. The Psychology of Money is not structured as an investment manual. There are no formulas to follow, no frameworks for stock screening, no allocation rules. What the book does is more foundational. It identifies the invisible forces that shape financial decisions and shows why those forces matter more than most investors want to admit. One of the central arguments Housel makes is deceptively simple. Financial outcomes are determined less by intelligence than by behavior. Two investors can hold an identical portfolio. They own the same funds, pay the same fees, and start on the same day. One holds for 30 years without interruption. The other exits during each significant decline, sometimes out of fear, sometimes out of conviction that something better is available, and then re-enters once conditions feel safer. After 3 decades, the gap between their outcomes is not subtle, and it has nothing to do with what they held. It has everything to do with what they did. Housel makes this concrete with a clear observation. An investor who earns a consistent, unremarkable average return over a long period will almost always outperform an investor who earns higher returns in strong years, but exits at the wrong moments. The continuity matters more than the rate. That is not a motivational claim. It is the result of how compounding actually works. But the book goes further than simply instructing you to stay invested. That's the easy part to say. The harder part is understanding why leaving at the wrong time is not a mistake. You can simply decide to avoid. Housel explains this through the asymmetry of how people experience financial loss. Most people feel the pain of losing $1,000 more sharply than they feel the satisfaction of gaining the same amount. This is not a personal flaw. It is a consistent, well-documented feature of how humans process financial outcomes. And once you understand it, you stop being surprised by your own reactions and you start designing for them. Imagine you've been building a dividend portfolio for 3 years. You've chosen funds with consistent payout growth. You've reinvested every distribution. You believe in the compounding mechanism. And then the market enters a prolonged correction. Your portfolio is down 25%. The dividends are still arriving, but they look smaller against a portfolio value that has dropped significantly. And the narrative around you, in the news, in forums, in conversations with friends, is that this time might be different. That is the moment the book prepares you for, not by making you immune to the feeling, but by making the feeling recognizable before it arrives. If you've already asked yourself, honestly, how you'll respond when you're down 25% and the environment feels uncertain, you've already made the decision. You're not making it in the middle of a correction when everything feels urgent. The book also draws a distinction that is easy to miss. Getting wealthy and staying wealthy require fundamentally different skills. Building toward a financial goal involves risk, conviction, and tolerance for being wrong in the short term. Sustaining and compounding what you've built requires patience, humility, and a genuine understanding that past performance gives you very limited information about what comes next. Most investors learn this in the wrong order. Recent outperformance feels like a signal. Positions get added near the top. Confidence is highest exactly when risk is highest. Then the correction arrives, and the pattern reverses in the most costly way. Housel captures this with a phrase that has stayed with me. Reasonable beats rational. The theoretically optimal portfolio is not always the one you will actually hold. The reasonable portfolio, the one that matches your emotional reality, not just a spreadsheet calculation, is the one that compounds over years. Think about what this means practically. You could identify a fund with a strong combination of yield, growth rate, and low expense ratio. You could build the case, clearly. But if you don't know how you'll respond when that fund drops 30% and the headlines are negative, the case is incomplete. The missing variable is you. The psychology of money treats that variable as the most important one, because in the end, it is. For dividend investors specifically, this has a direct edge. The question is not only whether the fund you're evaluating has a strong dividend growth track record. The question is whether you understand it clearly, enough to hold it through a period when the price is falling and the income feels disconnected from the account balance. If you can't answer that honestly, the return projections are beside the point. Reading The Psychology of Money will not give you a buy list. It will not tell you when to enter or exit a position. What it gives you is something most investment resources skip entirely. It gives you a framework for understanding yourself as the investor before the market puts that understanding to the test. Most investors encounter these lessons in real time. A position drops more than expected. They react. The decision they make in that moment costs them something. And only afterward, once things have stabilized, do they see what actually happened. They didn't fail because of bad research. They failed because they had never asked the harder question. How will I actually behave when this goes against me? The book inverts the sequence. Ask that question first. Map your own wiring before it gets activated by a declining market. Then build a strategy that works with that reality, not against it. That is a different kind of preparation. Not more data, more self-knowledge, and in the long run, that is what separates investors who compound steadily from those who keep restarting. The investor who understands their own behavior under pressure doesn't make fewer mistakes because they're smarter. They make fewer mistakes because they've already thought through what they'll do when the moment arrives. That preparation is quiet. It doesn't show up in your portfolio until years later. But when it does, the difference is unmistakable. Before you research the next position, know why you're holding it and how you'll actually respond when it tests you. That clarity is the foundation. The rest is execution. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.